Hello students, I'm Dr. Mohammed Salman, and in this video we are going to talk about financial derivatives. Now this is a video talking about a very introductory part of the financial derivatives. So we'll be getting the idea of what derivatives are and what financial derivatives are, how we can understand them, how we can define them, and what are the types of financial derivatives which are there. Then in this video we are also going to talk about the features of financial derivatives, that what are the characteristics or features of financial derivatives, and then we'll also discuss about its advantages for the economy and people as a whole. So this is concerning about a very introductory part of financial derivatives. And if we see from the point of view of syllabus of most of the MBA programs, this is kind of unit 1 and introductory part of unit 1. So understand derivative. We can easily understand derivative with the help of the mathematical word derivative, as it is well known that the term derivative has took place has took its inception from mathematical word derivation, which means a variable whose value is derived from another variable. So with this origin of derivatives, we can move further that these variables or these instruments, or let's say these values, they don't have their independent value. Their value or their magnitude depends on some other variable or some other item. So similarly, if we move bit more towards finance, we can say a derivative is something whose value is dependent upon some other financial instrument. Or rather, more specifically, we can say that a financial instrument whose value depends on underlying assets. So financial derivative is an instrument. It is also a financial product. It is also a financial instrument in which investment can be made, in which buying and selling can be done, in which trading has its place. So it is a one in which the value is not there of its own. It has a value which is derived from some underlying assets or some underlying contracts, we can say. Now, what are those underlying assets on whom the prices or the value of the derivatives depend? Well, they can be prices of traded securities of gold, they can be any other commodities, cardamom, it can be aluminium, copper, there can be fruits and vegetables. The agricultural products can also act as an underlying asset. There can be index, stock indexes, Nifty, Sensex. uh, so these type of assets, these type of financial assets can be their underlying item on whom the value of the financial instrument, or we can say the value of financial derivatives, depend. Now, to define derivative, the Securities Contract Regulation Act 1956 defined derivative as: derivative includes security derived from a debt instrument, share, loan, whether secured or unsecured, a risk instrument or contract for differences or any other form of security. So the first part of the definition by this act says that derivative can be anything which is a security derived from a debt instrument. So it can be a debt instrument on which its value is derived. It can be a share of a company, stock, that means loan, whether secured or unsecured. No matter the loan is secured or unsecured, the value of the derivative security or derivative instrument can depend on a loan also. Its value can also be derived from risk instruments or contract for differences or any other form of security. That means any kind of security can act as an underlying asset or underlying instrument for a security to be a derivative. Second category of the things which are included in derivative are a contract which drives its value from the prices or index of prices of underlying securities. So derivative also include all those contracts which drive its valuation from the prices or index of prices of underlying assets. So any underlying securities prices can be used for the valuation of these derivative contracts. Moving to another more comprehensive definition, a more detailed one, you can see the accounting standard SFAS 133 defines a derivative as a derivative instrument, financial derivative, or other contract with all the three of the following characteristics. So, what this accounting standards say that according to these accounting standards, there are three characteristics which should be there in an instrument for being a financial derivative. So first characteristic, it should have one or more underlying asset. So there should be a presence of one or more than one underlying asset and one or more notional amounts. So what is a notional amount? We'll be discussing about notional amounts more in detail in the coming videos, in the coming parts of this subject. But for now, for the introduction of notional amount, it is the amount which is calculated for the size of the contract. It doesn't have to be paid or it doesn't have to be received when the contract is being entered, but a notional amount or multiple notional amounts has to be there when we are talking about financial derivative, because this is the price which is notional, which is completely used to drive the value of whole contract. So those terms determine the amount of settlement or settlement. So what will be the amount of settlement of the contract is derived from notional amount. So first thing which has to be present in any contract or any derivative for being a financial derivative is there should be one or more underlying assets and there should be one or more notional amounts or payments through which the amount of whole contract is determined and through which settlement is derived. The second characteristic which should be there is it requires no initial net investment. Yes, financial derivatives require no initial net investment. There can be very small amount of principal amounts or premiums to enter into contract, but no net investment is required, or initial net investment there is smaller than would be required for other types of. So well, what this point is trying to say is that there is no requirement of net investment or net amount to be given for the purchase of the contract or entering into contract. There can be a very notional principal amount, there can be a small amount, a small proportion of whole notional amount which has to be given at the initiation of the contract, but no net investment is required in none of the financial derivative. The third important characteristic which should be there is its terms require or permit net settlement. Well, because there is no initial investment or exchange of whole net amount, but there should be terms, there should be written conditions, or you can say there should be written rules or regulations as to how the net settlement has to take place. So the terms which are required or which permit the net settlement should be there in the financial derivative. Instrument cannot become financial derivative if there is no provision of net settlement. It can be readily settled net by means notes outside the contract, or it provides for delivery of an asset that puts the recipients in a position not substantially different from net settlement. Now there can be different type of settlements. There can be settlements through promissory notes, through treasury notes outside the contract. There can be settlement through delivery of an asset, or however there can be settlement through delivery of cash. So there can be some way of net settlement at the time of maturity, at the time of the expiry of the contract, but it cannot become a financial derivative if there is no terms for the settlement. So if these three things are present in a financial instrument, it qualifies to become a financial derivative. Now, talking about a very simpler definition. Now, you have just gone through the definitions which were talking about very comprehensive functions of financial derivative, or which were talking about a very detailed features of financial derivatives. Now, there is a very simple definition which can give you an idea of what derivatives are, how they can be defined. So, in a very simple language, we can say derivatives can be defined as a contract that derives most of its value from some underlying asset, reference rate, or index. Now, this definition is not very much comprehensive. It doesn't tell you about very detailed features, it doesn't tell you about detailed characteristics, but to understand the meaning, but to just have an idea of what derivatives are, this definition plays a very good role, because it tells us that it is a contract. First of all, this definition is telling us that derivative is a contract. That means two parties are legally bound with each other, that derives most of its value from some underlying. Now, second important thing, that the value is being derived from some other underlying asset. The value is not its own. It doesn't have its own value, or it doesn't have its own valuation. Underlying asset, reference rate, or index. The third important thing which is coming out of this definition is that the underlying instrument can be some asset, it can be a reference rate, that means a rate of some other commodity which is being used for reference, or an index, it can be an index of other instruments, or index of other prices. So this definition can also be elaborated and understood in a very better manner. Now, talking about the features of financial derivatives. Now, as we have gone through these three definitions, in which two were very comprehensively talking about the details of its features, while one was a very brief one, although it also pointed out towards its features. So we can have these five basic features of financial derivatives through which we can understand its characteristics and how they are. So first one is a future contract. When we are talking about any financial derivative, may it be forward contract, future contract, may it be options, swaps, leaps, warrants, there can be any financial derivative. The basic thing, the basic feature which is present in every financial derivative is that they are talking about some future contract. So these financial derivatives talks about some transaction that has to be happened in the future. They talk about delivery of goods, delivery of asset, or settlement through cash at a future date. The settlement of these instruments, which are known as financial derivatives, takes place at some future date. So the value which has to be derived, the price that has to be paid, or the asset which has to be delivered, they all have to be taken at some future reference date. So these contracts are basically future contracts. They are entered today, but their terms will become valid at some predetermined future date. The second important characteristic is it is between two parties, that means that are called counterparties. Well, again, if we talk about any financial derivative, any kind of financial derivative, commodity, financial, any kind of it, we'll find that there is minimum involvement of two parties who are there. There can be a third one in some of the contracts who acts as an agent or facilitator, but he's not a direct party to the contract. Direct party to the contract are two only. There are multiple explanations through which you can justify this presence of two parties. The first one is that it is a contract. We have seen it multiple times in previous definition that it is stressed upon that future these financial derivatives are contract. And if you go back to the teachings of Indian Contract Act or any other contract act, you will find that any contract can be entered into by minimum two parties. One who is accepting the one who is proposing the contract, and one who is accepting the contract. So there can be two parties minimum. So again, in financial derivative also there has to be presence of two parties. In any financial derivative you will find that it is a contract, it is an agreement, it is a binding contract between two parties. And in this financial derivative we call them counterparties. Alright, so they are known as counterparties, the parties who are involved in this contract. Now, one more feature is there which is related to this presence of two parties, which is known as counterparty risk. It is not mentioned here, but it is an important feature. You can note it down that presence of counterparty risk. Now, counterparty risk is a kind of default risk. The risk which means that the parties can default on their role. The party who has to pay the money may default on a future date to pay the money, maybe due to bankruptcy, maybe due to any other unforeseen circumstances, maybe due to his death, maybe due to any changes in the law of the country. So there can be any reason for this default, but there can be a default because instinctively whenever two parties are involved in something, there is a necessarily presence of counterparty risk, that means a default risk. So this default risk or counterparty risk is present in every financial derivative. There can be legal consequences, there can be legal remedies, those are different, but we are talking about the presence of risk is present. However, there can be remedies for those risks, there can be penalties for those risks, but the presence is there. This is factual that the presence of counterparty risk is there in every financial derivative. The next feature is value is derived from underlying asset. Now you will find no definition in the world, you will find no explanation in the whole world about financial derivative which says that there is no derivation from underlying asset. So you travel all around the world, you listen all the authors, you read all the authors, you go through all the researches about financial derivative, you will find that the value of the derivative has to be derived from some underlying asset. Because this is the basic instinct of derivative. A derivative cannot be separated from some underlying asset. You cannot separate a word from its root. So this is the root of the derivative. The dependence upon some underlying asset is a root of any derivative. And for financial derivative, these underlying assets are financial in nature. So the value of financial derivatives are derived from underlying assets. That means the underlying asset, any treasury bill, treasury note, any commodity, any financial contract, any loan, any interest rate can act as an underlying asset based on whom, based on which the value of financial derivative is derived. The next is delivery of underlying asset is not involved in every financial derivative. Now, note down that this feature can or cannot be present in every financial derivative. So there can be financial derivatives in which this feature is not present. That means delivery of financial asset may be involved. Many forward contracts are there where delivery of financial asset is required. There are many commodity derivatives also where delivery of the asset is required. But when we talk about compulsion, so there is no compulsion of delivery of asset. There can be ways of settlement other than delivery of asset. There can be ways of settlement which is based on purely cash. There can be ways of settlement which are based on the differences in the prices over the duration. So there can be different ways of settlement. The delivery of underlying asset may or may not be required. All right. Next point is deferred payment. Financial derivatives also includes a feature known as deferred payment, because whenever you enter into a financial derivative, you are entering into the contract today, but you are not paying or receiving the whole net amount today. You are going to pay or receive the amount at a future predetermined date. So it is involving deferred payment, a payment which is deferred, which is delayed, which is not actually happening right now. So it is a very basic, very necessary and compulsory feature of every financial derivative that the payment has to be made at a future date. It is deferred, it is not taking place at the moment when contract is being entered into. So these are the basic features of financial derivatives. When we'll be discussing the different types of derivatives, the different features may come up. The different features which may be unique to particular contracts, particular types may come up, but these will be present in almost every financial derivative. Now, the advantages of derivatives. What are its advantages? What benefit they provide to the economy or to the people or to the government? First, they help in transferring risk from risk adverse people to risk oriented people. Now, there are people who want to escape from risk. There are people who want to hedge their risk. Suppose there is a person who is involved in cross currency transactions. He is paying money into some different currency by converting his own into that. Now again some payment has to be made in future, or some receipt has to be done in future. The delivery is done today. So in that case you will find that there is a risk which is involved in changing or fluctuating interest rates. Now this can be a very huge risk, because it may incur a very big loss to the big corporates. Big investors may incur a very big loss in slightest change in the interest rate or a slightest rate in the currency rate. So they have to adverse the risk. They have to avoid or escape the risk. But there are people who want to take risk. They are risk oriented people, because as we know the very basic principle of investment, that higher the risk, higher will be the return. So there are a lot of people, a lot of parties who are a risk oriented one. So through financial derivative, a very basic advantage is that a risk is transferred or shifted from risk averse people or risk averse individuals to risk oriented individuals. Another advantage is that they help in the discovery of future as well as current prices. Now, as we know that financial derivatives are dependent upon underlying assets, so the current prices of underlying assets can be discovered very carefully and very precisely, because of the involvement of many commodities and financial assets in the derivative market. Their prices has to be kept transparent and well informed and well circulated and broadcasted. So the current prices are very easily and very transparently visible to everyone. They can be discovered that what prices should prevail in the market. Similarly, future prices are also determined and discovered using these instruments, because the derivatives are actually talking about some future predetermined date. So the value of assets, the value of underlying commodities or instruments has to be very carefully seen at a predetermined future date. So future prices are also discovered and known or speculated at a current time. Another advantage is they catalyze entrepreneurial activity. Now, any entrepreneur, any person who is going out to venture his new business or new idea needs money. They need investment. This investment can be capitalized through the derivative market. Now, second thing which entrepreneurial activities need is that they need a risk aversion, because they are at the stepping stone. They are into the starting and struggling phase of their investment. So they need hedging of their risk. Now, another thing which is related to entrepreneurial activity is that there are certain times when there is requirement of some other currency denominations. There are certain times when they require some particular financial assets or instruments which they cannot get directly. So there are types of financial derivatives. For example, there are swaps through which you can get benefit of other currency or other financial derivatives, other financial instruments which you cannot get directly. So the financial derivatives actually help in fostering entrepreneurial activities and in smoothing the way of entrepreneurs. Next advantage is that they increase the volume traded in the markets because of participation of risk adverse people in greater number. So the volume which is traded in the market, in the derivative market, is increased because those people who are risk averse, they are also attracted to this market and they are also involved in the market activities. So the financial market or monetary system get the money, get the capital formation from those people also who are risk averse people. So an economy, any economy around the world can benefit from this point, that the people who are risk averse are also attracted in greater number and the volume which is traded in their financial market is increased. The next advantage is that they increase savings and investments in the long run. Now, for any economy to grow, it is very necessary that the savings and investments are rising, because the circle of finance involves capital formation, and capital formation comes from savings and investments. The savings which normal people do, the savings which corporates do, the investments which are there in the economy, they all determine the level of capital formation in the country. And the higher the capital formation will be there, the higher will be the growth prospects, because in industries which are working on in any country, they get capital from these sources only. They get capital, their amount of capital being raised depends on the level of capital formation in their economy, and also the rate of capital borrowing, the rate of interest at which the capital can be formed. That also depend on the size of capital formation in the economy, and it all depends on the level of savings and investment, and financial derivatives helps in increasing the savings and investment in the long run through their various products. Next is they help in stability of prices through arbitrage. Now that what happens, there is the presence of price disparity around the world. Price or interest rate disparities there around the world. Many a times it is happening that the price disparities in the same country happens in different markets. So this disparity can be removed, this disparity can be evaded through arbitrage of financial derivatives. You know that arbitrage is a situation in which the investors take advantage of differences in prices in different markets. So when this advantage is taken, the mechanism of market work, and due to differences in demand and supply, the prices tend to get stable. The price differences tend to be removed, and stability of prices happen to be there. So these are the basic advantage of financial derivatives. Now moving towards the classification of the derivatives. The derivative, as we know, depends upon some underlying asset. So first of all, the derivatives can be differentiated or distinguished on the basis of their nature, the basis of the nature of underlying asset. There can be financial derivative or there can be commodity derivatives. Financial derivatives are those ones which are dependent upon, which are derived from the financial assets. However, commodity derivatives are those derivatives which are dependent upon the commodities, the specific commodities. Now, talking about the classification of financial derivatives, there can be basic or complex, forward, future options, warrants, swaps, and exotic ones which are non standards. Well, seeing on this classification on the basic of nature, commodity derivatives which derive its value from some commodities. These commodities can be gold, silver, they can be any agricultural produce. So these derivatives help the manufacturers and producers to safeguard the risk of changing prices. These derivatives help a lot to the producers who fear the falling prices in future. Now these derivatives also help the investors to make money. So the investors who are taking risk by investing today, so they can have benefit of rising future prices in future. Now the financial derivatives are those derivatives which depend upon some underlying financial assets. So there can be index, there can be stock indexes, it can be loans, it can be interest rates, it can be currencies. So any financial instruments are acting as underlying assets, then the derivative will be known as financial derivative. The examples can be forwards, futures, options, swaps, warrants, and convertibles. There can be many exotic ones which are non-standard or completely customized contracts. We'll be discussing about all these contracts in detail in the coming videos. The coming units talk about forwards, futures, options, and swaps as per the syllabus which we are following, as per the syllabus of most of the universities in India for masters. Forward, future, options, and swaps are concerned. Now, when we talk about the another classification, one more classification is there for financial derivatives is on the basis of the market traded. In which market, through which medium are they being traded? Now, by meaning this market being traded is, we can say that through which medium or through which market the two parties, the counterparties, are coming together and entering into the contract. Alright, so it is basically the medium through which the parties are interacting with each other and entering into the contract, and through which settlement is being taken place, and the medium of which the regulations or terms are being implied on the contracts. So there can be two, the exchange traded ones, and the second one, the over the counter traded derivatives. So exchange traded derivatives are those derivatives which are traded through specific or standardized stock exchanges. They are standardized derivative contracts in which the terms and regulations are standardized, same for everyone. The maturity date, the settlement amount, the ways of settlement, everything is predetermined and already standardized. But when we talk about over the counter derivatives, they are basically customizable contracts. Through over the counter market, those derivatives are traded which are customizable, which are tailor made contracts, which are made according to the needs of the parties. though the counterparties can fix up their own terms, its regulations, and the terms which will be followed, the maturity date, the ways of settlement, the periodic payments, everything, n number of things are there. Everything are tailor made, they are determined by the parties themselves as per their mutual benefit and as per their mutual need. So these over-the-counter ones are tailor-made or customizable contracts. However, exchange-traded derivatives are standardized derivatives. Usually, forwards and swaps are traded upon over-the-counter ones. However, there can be forwards and swaps which are exchange-traded. Many options can also be created for over the counter market. However, futures mostly are dealt on, or usually we say that futures are only traded upon exchanges. However, there can be many options also which are exchange traded ones. Thank you for going on through this video. I hope the things will be clear. And if there are any queries, you can contact me. And thank you so much. Stay safe. Have a nice day.